This is a presentation of Chapter 19, Accounting for Income Taxes. In this part of the presentation, we will provide more examples of temporary differences that result in deferred tax assets and liabilities, as well as discuss permanent differences that will never reverse and the effects of changes in tax rates. As discussed in the previous presentation, we have two components of income tax expense. The current portion is the amount that is shown either payable or refundable on the income tax return. The deferred component is the change in the deferred tax assets and liabilities from the beginning to the ending of the period. The two components can be shown on the face of the income statement or disclosed in the notes. This is the example of the two components for the first year of Chelsea Inc. that we looked at in the first presentation. The current portion, $8,000, would be the actual amount that is owed on the tax return. The deferred portion, $6,000, was the deferred tax liability that was recorded due to the temporary timing difference for the accounts receivable and sales that were accrued in 2020 for financial reporting purposes. As we discussed in the first presentation, there are two types of temporary differences. Some temporary differences will result in deferred tax liabilities. These deferred tax liabilities represent increases in income taxes owed in the future as the temporary differences reverse and the amounts are reported on the income tax return. The deferred tax assets represent decreases in income taxes owed in the future as the temporary differences reverse and the amounts are reported on the tax return. Remember that temporary differences result because accrual basis accounting is used to report financial income per GAAP, and the modified cash basis is used to calculate taxable income per the tax code. This slide shows examples of revenue accruals that are made under generally accepted accounting, but the tax code does not require the revenue to be reported until a later date. These types of differences will result in deferred tax liabilities. Most of these you will have already studied in this class or previously. Accrual basis accounting for sales requires revenue to be recorded when the performance obligation has been satisfied, but for tax purposes when the cash is collected. Under percentage of completion, we record revenue over the life of the contract, but for completed contract, revenue is not recorded until the contract is complete. Income is recorded for the percentage of the investee's net income using the equity method, but for tax purposes, income is recorded only when dividends are received. Gains on involuntary conversions of non-monetary assets for accrual basis would be recorded when known, but for tax purposes only when cash is received. Unrealized holding gains on investments are recorded under GAAP each year as adjusting entries, but for tax purposes only when they are actually realized. Some temporary differences involve accruals of expenses that will result in deferred tax assets because the deductions will be taken for financial reporting purposes prior to the reporting of the deductions on the tax return when they are actually paid. This slide shows common types of accrued expenses for financial reporting purposes. We also defer the recording of revenues for financial reporting purposes if we have received cash prior to satisfying our performance obligations. However, the tax code requires that we report cash received as income in the tax return. This slide shows examples of deferred revenue that would be reported on the tax return prior to the reporting of the revenue for financial statement purposes. These examples will result in deferred tax assets. We also defer expenses that we have paid for in advance of utilizing the benefits. The most common example of this is MACRS, Modified Accelerated Cost Recovery System, the depreciation method used for tax purposes, and some other method for financial reporting purposes that is not accelerated, such as straight line. It is not acceptable to use MACRS for financial reporting purposes, so depreciation methods will cause a difference in pre-tax financial income and taxable income for most businesses. Timing differences can also occur when more cash is paid for pension obligations than is deductible for financial reporting purposes. The last example is where we prepay expenses such as insurance or supplies prior to using them. These types of prepaid expenses or accelerated depreciation will result in deferred tax liabilities because of lower expenses reported on the tax return in the future than on the financial statement. As we noted in the first presentation, it is important to distinguish between originating differences, where the initial difference is recorded, and the reversing amounts. Every temporary difference, whether taxable or deductible, will have an originating entry, such as the recording of the accrual of sales and accounts receivable, and then one or more reversing entries, such as when the accounts receivable are later collected. There are some differences in financial statement and tax return income or expenses that will never reverse. They will either be reported in the financial statements but never in the tax return, or vice versa. These do not result in the recording of either deferred tax assets or liabilities in the financial statements. They will change the effective tax rates that are paid. These are examples of permanent differences where the items are included in the financial statements but are never included in the tax return. Interest on state and municipal obligations are not taxable, but neither are expenses associated with them deductible. Life insurance proceeds on policies that the business carries on their key officers and employees are never taxable, but the premiums paid on the policies are also not deductible. Fines and penalties resulting from violations of laws are not deductible on the tax return. All of these examples would be included in the financial statements, though. These are two examples of deductions that can be taken on the tax return, but not in the financial statements. Congress grants these deductions that GAAP does not allow because it is consistent with public policy. I won't go into detail about these because they should be covered in a tax class to fully understand them. But the first one, for percentage depletion, would allow a company to take a deduction in excess of their cost for a natural resource, such as an oil well. The purpose behind this deduction is to encourage companies to remove all of the oil from a well when there is not much left. The second deduction is very common but is only for corporations and allows them to take a deduction for dividends from U.S. corporations that they receive based on this percentage of stock that they own. Now we will have an exercise to check to see if you can identify temporary differences that would result in future deductible amounts and a deferred tax asset, or future taxable amounts that would result in a deferred tax liability, or if they represent a permanent difference. The first one, Maker's depreciation system, is used for tax purposes, and straight line depreciation is used for financial reporting purposes, will result in future taxable amounts because the Maker's depreciation is more accelerated than straight line, so there will be fewer deductions for tax purposes in the future. The second one, a landlord collects some rents in advance. Rents received are taxable in the period when they are received, will result in a deferred tax asset because the income will have already been reported on the tax return prior to being reported in the financial statements. The third one, expenses are incurred in obtaining tax-exempt income, is a permanent difference. Expenses in obtaining tax-exempt income are never deductible on the tax return. The cost of guarantees and warranties are estimated and accrued for financial reporting purposes will result in deferred tax assets because they will be deductible later on the tax return when they are actually paid. Installment sales of investments are accounted for by the accrual method for financial reporting purposes and the installment method for tax purposes. This will result in future taxable amounts as the cash is collected and the amounts are reported on the tax return. Proceeds are received from a life insurance company because the death of a key officer, the company carries a policy on key officers. This will be a permanent difference. When calculating deferred tax assets and liabilities, companies should use the tax rates that have been enacted at the balance sheet date. When tax rates change, companies should report the changes in their deferred tax assets and liabilities as an adjustment to income tax expense in the period of the change. Next, we are going to discuss net operating loss carryforwards. A net operating loss occurs on the tax return when tax-deductible expenses exceed revenues. No tax is due in the year of the loss, and the current tax law allows for the carry forward of losses from 1 year to future tax periods to reduce income taxes payable. There are some limitations on the amount of net operating losses that can be taken against future taxable income that you will cover in your tax courses. But the carry forward period is currently indefinite for tax periods beginning in 2018. This has not always been the case. Prior to the new tax law passed in 2017, the carry forward was limited to 20 years and there was a carryback provision of 2 years. To illustrate a net operating loss and the resulting deferred tax asset, we will assume that Grow Inc. has no other temporary or permanent differences but experiences a net operating loss of $200,000 in 2020. They would record the tax effect for the carry forward, which is equal to $200,000 times the current tax rate of 20% by debiting deferred tax asset and crediting income tax expense or loss carry forward for $40,000. The deferred benefit would be shown on the income statement as a reduction in the net operating loss before income taxes of $200,000 for a net loss of $160,000. If Grow had taxable income of $250,000 for 2021 before credit for the net operating loss, they would be able to utilize all of the net operating loss carry forward from 2020 in this period. The net operating loss carry forward of $200,000 from 2020 would reduce Grow's taxable income from $250,000 to $50,000, and there would be no remaining carry forward from 2020. Income taxes payable for 2021 would be $10,000, which is equal to $50,000 of taxable income times the tax rate of 20%. To record the income tax expense for 2021, Grow would debit income tax expense for $50,000 and credit deferred tax asset for $40,000 and income tax payable for $10,000. On the income statement for 2021, the current portion of the income tax expenses would be $10,000 per the tax return, and the deferred portion would be $40,000, which is equal to the deferred tax asset that was utilized completely in 2021. Total income tax expense for 2021 would be $50,000 and net income $200,000. As was illustrated previously, deferred tax assets must be tested for impairment at the end of each year. If Grow felt that it would not be able to utilize any of the $40,000 deferred tax asset recorded in 2020, it would record a debit to income tax expense or allowance for $40,000 and a credit to allowance to reduce deferred tax asset to expected realizable value for the same amount. The allowance could be adjusted in future periods should Grow determine that they would be able to utilize the carry forward. There would be no deferred tax benefit shown on the income statement if Grow recorded the valuation allowance as illustrated in the previous slide. The net operating loss before income taxes and after would be the same, $200,000. If in 2021 Grow had $250,000 of taxable income before the net operating loss deduction and could now utilize the net operating loss carry forward, it would record the entry for income tax expense for 2021 by debiting income tax expense for $50,000 and crediting deferred tax asset for $40,000 and income tax payable for $10,000. They would also debit the allowance recorded in 2020 and record a credit to income tax expense or allowance for $40,000. In 2021, the income statement would only show the current tax liability of $10,000. The deferred portion would be zero since the carry forward and the reversal of the allowance would offset each other. When determining whether or not to record a valuation allowance for deferred tax assets, companies need to consider whether they will generate sufficient income in the future to utilize the carry forward in the period available under current tax law. Some of the information that companies can use in determining whether to record a valuation allowance include whether they have reversals of existing temporary differences or other sources of taxable income to use the carry forward. Some tax planning strategies that might help to generate additional taxable income would be to accelerate taxable amounts, change the character of taxable or deductible amounts from ordinary income or loss to capital gain or loss, or switch from tax exempt to taxable investments. Some examples of negative evidence that would indicate that an allowance should be recorded include a history of net operating losses expiring unused, losses expected in future years, unsettled circumstances that would adversely impact future operations, reversals of significant deductible temporary differences, or operating in a traditionally cyclical business. Some positive evidence that could indicate that an allowance is not needed would include existing contracts or sales backlogs to generate enough taxable income, appreciated assets over tax basis, or a strong earnings history indicating that the operating loss was an aberration. Next, we will discuss presentation of deferred income taxes in the financial statements. Income taxes payable and receivable should be reported as current assets and liabilities on the balance sheet. However, deferred tax assets and liabilities should be reported as a net non-current amount on the balance sheet. This is an example of the determination of deferred tax assets and liabilities on the balance sheet. The deferred tax assets are added together and equal $54,000. The deferred tax liabilities are added together and equal $259,000. Netting the total deferred tax assets and liabilities produces a net deferred tax liability of $205,000. This amount should be reported on the balance sheet as a net non-current liability. Companies need to disclose in the notes the total of all deferred tax assets, liabilities, and the total valuation allowance. They also need to disclose the change in the valuation allowance, as well as the types of temporary differences and carryforwards that give rise to the deferred tax assets and liabilities. This diagram is a good review of the accounting for deferred taxes. First, companies should identify types and amounts of taxable and deductible temporary differences and carryforwards. Next, they should measure the deferred tax liabilities for any taxable temporary differences and deferred tax assets for any deductible temporary differences and net operating loss carryforwards. They should determine if they need to record a valuation allowance for the deferred tax assets recorded. On the balance sheet, they should classify the net deferred tax asset or liability as non-current, and on the income statement or in the notes, show the current and deferred portions of income tax expense or benefit. The comprehensive tax allocation problem will be presented in a separate video using Excel. As we stated previously, there is no net operating loss carryback for tax periods beginning in 2018 per the Tax Cuts and Jobs Act of 2017. Under the previous federal law, you could carry back a net operating loss for 2 years and then carry forward the remaining amount for 20 years. Companies could forego the carryback and elect just to carry forward. Companies generally elected to carry back when they had taxable income in the prior periods and could receive refunds of amounts previously paid. States also have their own carryback and carry forward periods that differ from the federal law. These are your quiz hints for Chapter 19. Make sure you do your homework first because this is the best preparation for the quizzes. This is the review information for the problems for the exam. And this is the end of the presentation for Chapter 19.